You're listening to Uranium Spotlight on Tuesday, January 7th, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, New Year's spot prices rebound. Kazakhstan temporarily shuts down Inkai. Canada looks to reclaim the number one spot in uranium production, and the Paladin-Fission deal receives approval. The uranium market closed 2024 with notable shifts in both spot and long-term pricing, creating a compelling backdrop for investors heading into 2025. After spot uranium prices reached a high of $107 a pound in early 2024, they retreated, stabilizing between the high 70s and low 80s for much of the year. December saw further declines, with the year-end spot price settling at $71.75 a pound, down nearly $6 from November. Encouragingly, the spot market showed signs of recovery as 2025 began, with prices rebounding to close at $77 a pound on Friday. This resurgence signals renewed buying interest and could mark the beginning of a broader upward trend. While the spot market fluctuated, long-term uranium prices demonstrated resilience, climbing to $79 a pound by year-end, their highest level since 2022. This divergence highlights growing concerns over future supply constraints and production costs, which could spur renewed investment in mining projects. Looking ahead, 2025 promises both challenges and opportunities. Supply disruptions loom, as evidenced by last week's suspension of production at Kazakhstan's JV Inkai. Incremental increases in mine output are expected, but uncertainties remain regarding new project approvals. Price volatility could persist as utilities weigh contracting needs against shifting market dynamics. For uranium equity investors, the current environment underscores the critical interplay between near-term pricing trends and longer-term supply-demand fundamentals. With spot prices recovering and long-term concerns driving investment, the stage is set for a dynamic year. Kazamprom has temporarily shut down Block 1 of its Inkai mine in Kazakhstan's Turkestan region due to administrative delays. According to a recent company statement, Kazamprom failed to submit the required documents within the specified timeframe under Kazakhstan's subsoil use regulations, preventing continued operations at the site. Efforts are underway to resolve the issue, with Kazamprom expected to file the necessary paperwork in the coming weeks. However, regulatory approvals will take additional time, leaving the mine inactive for several weeks. This impacts Cameco, Kazamprom's joint venture partner, which holds a 40% stake in the mine. Cameco has expressed disappointment and surprise at the situation. The company stated, "We're seeking further clarification on how this transpired, as well as assessing the potential impacts on 2025 and 2026 production, financial outcomes, and future dividends. We're also exploring ways to help support Kazamprom in restarting the operation." The shutdown raises questions about the potential ripple effect on uranium markets. Cameco, which has a strong foothold in Canada's uranium-rich Athabasca Basin, may look to prioritize operations there. CEO Tim Gitzel noted, "We can increase production if the markets call for it," signaling a readiness to respond to potential supply shortages. On a broader geopolitical level, the disruption in Kazakhstan could have significant implications. Kazakhstan, the world's largest uranium producer, sends 90% of its output to Russia and China. The incident follows recent developments in Niger, where the military government aligned with Russia seized uranium mines from Orano under unclear circumstances. Niger is now considering partnerships with Russia, Turkish, and Chinese firms for development, further complicating global uranium supply chains. While Kazamprom's situation may stem from procedural missteps, it's hard to ignore the possibility of strategic motivations. Kazakhstan's alignment with Russia adds to the complexity, particularly given increasing bifurcation in the uranium market. Western reactor operators are already grappling with limited access to fuel due to sanctions and bans on uranium trade between U.S. and Russia, with similar measures under consideration in Europe. Adding to supply constraints, Australia, home of the world's largest estimated uranium reserves, restricts mining in 6 of its 8 states, limiting its potential as a top global supplier. Without policy shifts, these untapped reserves remain a bottleneck in a market facing growing demand and geopolitical hurdles. Canada is aiming to reclaim its position as the world's largest uranium producer, a title it ceded to Kazakhstan and Kazamprom over the past decade. Canadian producers like Denison Mines, NextGen Energy, and Cameco are leaving the past behind and looking toward the future with ambitious plans to double the country's uranium output by 2035. Adding to the excitement, Australian company Paladin Energy has recently entered the Canadian market with its acquisition of Fission Uranium Corp. Together, Denison and Paladin project a combined output of 18 million pounds of uranium from the Wheeler River project and Patterson Lake developments, which are still in progress. Cameco, meanwhile, is considering a 33% production expansion at McArthur River, targeting 25 million pounds, and anticipates producing 37 million pounds in 2025, a substantial leap from the 22 million pounds it achieved in 2024. Cameco's operational advancements are noteworthy. During the years its mines are offline due to low uranium prices, the company implemented significant automation, enabling faster scaling of production. NextGen Energy's Rook I project, in its final environmental approval stages, promises to start production soon, with an initial target of at least 30 million pounds annually. NextGen even forecasts that Rook I could surpass Kazakhstan's entire uranium output within 5 years. A resurgence of Canada's uranium industry would be a major win for Western reactor operators seeking reliable fuel sources with reduced geopolitical risks. However, the path forward isn't without challenges. Potential U.S. tariffs on uranium imports under the Trump administration or retaliatory Canadian export tariffs could strain trade relations. Canada is currently the largest uranium exporter to the U.S., so any trade disruptions could ripple through the market. Saskatchewan's government has already vowed to oppose any export tariffs on its resources, including uranium, potash, and oil. Despite these headwinds, the future looks bright. Cameco CEO Timothy Gitzel remarked, "I've been in this game, the nuclear business, for over 40 years, and I don't think I've ever seen the long-term fundamentals as good as they are today, like around the world." Global demand for uranium is expected to rise sharply as nuclear reactors gain favor as a low-carbon energy solution in the fight against climate change. Even with Canada operating at full capacity, it may struggle to meet the rising demand, particularly if it shoulders the burden of supplying its Western allies. To bridge the gap, Australia could play a pivotal role by tapping into its vast uranium reserves, but for now, Canada stands alone as the leader in Western uranium supply. For investors watching the uranium equities market, Canada's resurgence offers significant opportunities, especially as global energy markets pivot towards sustainable and geopolitically stable solutions. The uranium sector just witnessed a significant development with the approval of Paladin Energy's $1.14 billion acquisition of Canada's Fission Uranium. This long-anticipated deal, centered on Fission's Patterson Lake South, or PLS, uranium project in Saskatchewan, was finalized on December 18th after a thorough national security review under Canada's Investment Act. The project is estimated to hold about 5% of global uranium supply, making it a strategic asset in the Athabasca Basin. Canada's Federal Industry Minister Champagne, however, imposed strict conditions aimed at curbing China's influence. While Fission's largest shareholder, CGN Mining, linked to China's state-owned nuclear firm, will retain its offtake agreement for 3 years, Paladin has agreed not to sell additional uranium from PLS to Chinese parties thereafter. Furthermore, no new investments or securities will be issued to Chinese-based entities. Minister Champagne also mandated governance changes, requiring Paladin to appoint an independent Canadian to the board and ensure senior executives have no ties to Chinese state-owned enterprises. These measures align with Canada's broader effort to reduce China's control over critical resources. Despite earlier uncertainty, Paladin's CEO Ian Purdy expressed optimism about the deal's completion early this year. While shares of both companies face volatility, the approval marks a pivotal moment for the uranium market, reflecting Canada's strategic approach to resource security amid rising global demand. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight Podcast, brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next week.